section with us at Entrepreneurs Corner on Ascent Consult. My name is Kutsi Oluwatosin Mutunrayo, and the topic before us is accounts and bookkeeping for business owners. So mostly, especially for startups, majority of entrepreneurs they feel like, oh, since I'm just the only one handling the business, it's just me, I don't need to keep records, or I have everything all in my brain. I have a friend who was like, he runs a business, then he said that he doesn't even prepare invoice. It's only for those online people that ask for invoice, that he send invoice to. But for his day-to-day customers that come in and go out, he doesn't prepare invoice, and he doesn't have a record that he knows everything of it. And I was like, hey, a day will come. It's only if you are not thinking of expanding the business, even if, no matter how small the business is, it is essential that you keep all records. It is essential that you take note of everything that is coming in and that is going out of the business for future purpose. So before we go further, what is bookkeeping? Bookkeeping is a process of recording. Bookkeeping and accounting is a process of recording and organizing all the business transactions that have occurred in the course of the business. That is, it involves our day-to-day financial transaction. That is, we have what came in, how much was the total amount I made today, how much was the total amount I spent, what were your expenses, what were your inflow, what was your outflow. It helps you to record them, and you organize them in, you can have them in a file, you can have them. For a startup, you might not necessarily need all those big accounting tools. You can just make use of normal Excel, your Excel sheets. Have a debit side, have a credit side. The debit side for outflow, then the credit side for inflow. All financial transactions such as sales and revenue, payment of taxes and interest, payroll, and other operational expenses, loan, investment, are recorded in the books of accounts. Like, you have to know everything in your accounts. You have to know your payroll, that's if you have employees, and you have to know the operational expenses, which is your day-to-day running activities. Then your payment of tax. At the end of the year, the government will come and ask you for your company income tax. Then you have to know the sales. At least if you are doing a business, you must know that, am I making a profit or not? Because you cannot just, some people, as they are collecting the money, they are spending it, and then at the end of the day they'll be like, business, what the food, like they will say it in Yoruba. But then it is a key component in forming the financial statement of the organization at the end of the year. If you have a good record system, you are able to form a financial statement of your organization at the end of the year. There are many methods of bookkeeping, but the most common one are the double entry system. Like I said, double entry system, the system that has the debit and the credit, what's coming in and what is going out. But even methods other than these involve the process of recording financial transactions and accepting bookkeeping process. What is record keeping? Record keeping is a primary stage of accounting that entails keeping a record of monetary transactions, knowing the correct picture of your assets and liabilities. When there is no record keeping, you cannot know what it is, like the financial position of your company or your business. Where is the business at the moment? Are we making a profit or are we making a loss? What are our assets? What are our liabilities? But when you do so, you are able to know all of these. In addition, it assists in maintaining control of the expenses to minimize the expenditure and have important information for legal and tax purposes. When you keep record, you minimize spending unnecessarily. For some people, when you don't keep record, you buy things that the business might not even need, and you even buy things outside of the business, like you are spending your business money, you're using it for personal use, which is not supposed to be. Because in the long run, by the time federal governments will come, legal people will come for tax purposes, you will be charged for all of this. For small business owners everywhere, Record keeping is necessary and sometimes a tricky part of making sure a business runs smoothly. Keeping clear records of income, expenses, employee tax documents. This brings peace of mind and helps you to monitor progress towards goals and save you money and time. If you are doing all of this, you are obviously your mind will be at peace, because you can't say maybe you get an invite that tax officials are coming, or you're asked to bring out your account statement and you'll be like, I don't have it. But once you have all of that in a place, even if it might not be up to date or it might not even be so bulk out like that, but once you have it, at least you're at peace in your mind, and it helps you to control, it helps to work towards your goal, and you save your money and your time. What are the advantages of record keeping? One of the advantages of record keeping is permanent and reliable records. It helps maintain the permanent record of all transactions, which helps ensure the reliability of data. And when you are keeping your record, ensure that all your files are duplicated. Like, don't just have it in one place. You can keep it on a drive so it doesn't get missing. And also ensure that you have physical documents also. Then arithmetic accuracy of the account. Continuous recording of transaction will assist in identifying any arithmetic inaccuracies that have occurred. For example, excess payment to suppliers or double treatment of a transaction. Once you are always keeping records all the time, maybe you did a transfer to a particular supplier and you did it twice. If you go back to your records when you are taking note of what you've done for the day, you'll be able to picture that, I made a mistake, or I over transferred money, or I even transferred the wrong thing to this particular supplier. But when all of that is not done, like you've done it, you didn't go back to double check, it's all gone. So it helps for arithmetic accuracy of the account. It also ascertains the financial position of the business. When you keep records and at the end of the year, it depends on how often you check, at the end of the week or at the end of the month, you tend to know where the business is at the moment. Are we making a profit or a loss, like I said? And it also helps for collection of dues. All the outstanding liabilities and dues at a given time can be calculated based on the financial statement prepared. By the time you have your financial statements prepared, you would know which are the ones that are owing and the ones that you are meant to pay. That is your accounts payable and your accounts receivable. It helps to control. It helps control over assets and borrowing. That is, it features better control over assets and borrowing can be undertaken. This will help to manage the funds and various positions of the business. And it also helps for taxation. It is highly recommended and needed by tax authorities to complete their assessments. Like, they will need it once they are doing their tax assessment. Not only your bank statement, but your records will be requested by the tax officials. Now we have the most common accounts that business owners keep. What are the most common accounts business owners keep? They keep cash, that is a regular debit balance. Most business transactions will go through your cash account. And there's always a cash account. This transaction can be divided both into cash receipts, that is debit to cash, and cash disbursement, credit to cash. At the end of each month, you should reconcile the bank account of any outstanding transaction. Ensure that you always request for your bank statement and to check for outstanding errors, like the records you are keeping, that is your Excel sheet you are keeping, and the one that you receive from the bank. You double check to ensure that there are no records and that there is nothing that is missing or any outstanding. For example, when you write a check, it should be recorded in your accounting records. However, it may not be clear, like it may not have cleared it on the bank on that same day. And if it's still outstanding at the end of the month, it should be listed as an outstanding check. Then we have accounts receivable, which is a debit balance. This is the money due from your customer. mainly for products or services sold for which the company is yet to receive. That is, the money that your your clients are owing you are known as accounts receivable. If you don't have it recorded somewhere, you might forget that this particular person promised to pay. Maybe you run a 30-day system, or you run a 25-day system, or a 45-day or 60 days. You must have it recorded that, oh, at the end of 30th September, I'm to collect so amount from so clients. So that is what this accounts receivable is meant for. It's a sub ledger which shows the details of each account, and all the list and all the sub ledger should be reconciled to the total amount receivable listing to ensure their balance. We also have the inventory. This may be the ready to sell or work in progress. This inventory has to be the raw materials, and it can be in work in progress, it can be raw materials, and it can be already made goods. That is, physical counts of inventory should take place periodically. If you are selling physical items, you should take stock of it periodically to make sure that the accounting records agree with the actual inventory on hand. Whatever you have as an inventory on your records should also be the same thing you have in your storehouse. Ensure that you take periodical check on it every time. Tracking and allocating portion of inventory can be very complex though, but variances between actual and accounting inventory can result from an inaccurate tracking of raw inventory, used and finished goods, and it can help you to identify a theft if there is a theft. So we have another one. We have accounts payable. Similar to accounts receivable, it's the other way. Accounts receivable is what you are expecting from your clients, but accounts payable is the money the business itself owes the suppliers. So some business, they tend to pay their suppliers after 30 days. Like, they have that relationship that, oh, we don't do cash and carry, we pay you once we receive payment. So this will help you to know, oh, this is a particular client supplier I'm supposed to pay at this moment, and this is the ones I've paid, and this is the one that is left. So that's the importance of accounts payable, and it's very necessary that we keep it also. We also have a loan payable, which is on the credit balance. These are amounts that have been loaned to the company. Often in small businesses, this will be from shareholders or friends or family. Most businesses, they operate on loans, and you must keep an account so that you know that, oh, you have to pay a loan company, and the interest that we're collecting at the end of each month. We also have a sales account, which is the income earned by the company from selling its products or services. And we have expenses account. This shows all the expenses incurred by the business, and it could be divided into general types such as office expenses, rent, insurance, cost of goods sold, which is a calculation based on inventory purchased and used during the period. We also have the payroll expenses, that is the money you pay for those working with you. For many companies, this is one of the biggest expenses. This account includes salary paid to employees. We have vacation paid, employees benefits, and employees insurance. Now, what are the steps of record keeping? Number one, identifying the transaction. You identify what transaction you are about to keep. That's like what I said. Is it the sales account? Is it the accounts payable? Is it the account receivable? And number two, you are recording in the journal. You open each journal for each of them. Number three, you classify the nature of the transaction. You must know the nature of the transaction you are about keeping. Then you post to the journal, that is to the ledger rather, the one that will be on the debit side, the one that will be on the credit side. Then you balance your account to ensure the accuracy of the transaction you are keeping. Then you also prepare a financial statement which will show the financial position of the business. And you interpret the financial statement. By the time you're done preparing your financial statement, you will know whether the business is making a profit or a loss. Well, that will lead you to interpreting what the financial statement states. Then you communicate it to your stakeholders. That's if you have a stakeholder in the firm. Then the next thing we'll be looking at now is how to reduce stress of financial record keeping, because some people will say, oh, this is so stressful, especially if the business is still very young and you can't really afford for an accountant at the moment. So number one, you establish business bank account. A business must distinguish, like there must be a difference from the owner and the business. It's not like you'll be using your personal account for your business. If you are starting a company or you're starting a business, ensure that you open an account for it. You don't use your personal account for your business. A business must be distinguishable from the owner, and the easiest way to accomplish this is to establish bank accounts specifically for the business. Like I said, not only does this allow for the business to be different from its owner, it also separates business activities and expenses from personal ones. A business bank account allows for you to easily track business income and expenses. Wherever you are using your own personal account for your business, you cannot know the expenses that you spend for yourself different from the expenses that is for the business. So always ensure that your business account is different from your personal account. Money that is meant for the business should stick for the business, and not that you are spending business money for personal use. Always ensure that. Then number two, avoid using cash. You know money now, you can just spend money anyhow and it can be stolen sef, apart from you just spending it anyhow. So spending cash without a proper documentation makes it especially difficult for business owners to keep and maintain proper financial record. If your business is the one that you deal with cash every day, like you're buying and you're selling, ensure that maybe at the end of the day, at the end of that very day, you are taking it to the bank, or you have a save where you maybe at the end of the week you take it and go and deposit at the bank. It is easy to forget how and where cash was spent without the proper documentation. It is recommended that you use a credit or a debit card, or check instead of cash, as there is a paper trail to follow, and this practice will keep track of expenses. When you use cash instead of other methods of payment, you could also potentially be missing out on taking advantages of write-offs, and there is no documented proof. I can come and say I gave you this, and at the end of the day you don't have anything to prove for it. But whereby you use like a debit card or a credit card, there's always proof of the money that was sent. If you need to use cash, pull out money from the ATM and take notes on the receipt as the purpose of the withdrawal. Then another way is to schedule a specific time each week. If you are going to be keeping and maintaining your business record, be sure to schedule a specific time each week to devote to keeping your records correct. If it's maybe at the end, you might pick a day in the week to make sure that you cross check and you double check in case you are missing out on your account, instead of you waiting till the end of the month, which can be so time consuming. Take out some time each week to review your income and your expenses and manage your accounts receivable and payable. Establishing a set schedule will help to ensure that you stay on top of your financial record, and this will give you the necessary overview of how your business is doing and allows you to control your cash flow. So please, let's always ensure that we do this. Another way is to purchase the right accounting software. If your business is already growing, you might need an accounting software that will help you, and it's always most times automated. Like maybe you have to prepare invoice, it's not like you have to start going through the manual process. You can just use the automated one. And we also have for tax obligation. Keeping and maintaining accurate records means that you are able to meet at all the tax obligation and regular filing requirements without having to worry about a penalty or interest if you miss on late payment. All of this is where having a reliable accounting software proves to be valuable and this will help immensely in finding your monthly value added tax. Also, keep a complete keep a complete record of accounting document. Like I said, you might need to have a physical document also, and ensure that if you're having the physical document, you are maybe doing like a soft copy on your file. Google Drive is advisable in case your system crashes and the like, so you don't tend to lose out all your records. So business are required to keep accounting records. Not only is it enough to keep the records, they must be sufficient to show and explain the business transaction. In accounting records for your business, your record must contain all assets and liabilities of the company, all entries from day to day, and the sum of money received and is expected by the company. And some of the documents which is requested of you could be your invoices and receipts you provide for sales. It could be your invoice for goods and services that you sold, and it could be your bank account statements, your credit card statements, your financial statements, and records of payments made to employees, that is if your pay slip, and record of stock and purchases. In conclusion, for every business there must be a record. You can't have a business and not have a record. If you are saying that you have your records offered, you are still joking. You've not started yet, and it will affect you in the long run. So ensure, no matter how naive or how little it might be, ensure that you know okay, this is what came in, have it somewhere, this is what is going out, have it somewhere, this is what I spent, and this is what we use to run the business at the end of the week or at the end of the month. For every business there must be a record. Anything that involves both cash and credit transfer for the business, ensure that it is recorded. Keep everything recorded. Record everything. This will save you a lot of stress in the future. I hope that after today, for every business out there that you've not been keeping records, I hope after today you would imbibe this in your culture, and you will see that you will save yourself a lot of stress.